Hi guys, welcome back to the channel. My name is Dave, and today I want to talk about HEQT, which comes to us from the mountains of Colorado, or Simplify ETFs. Let's go with that. So these guys have put together an interesting ETF that is worth examining and seeing if we can utilize it ourselves. They're going to be investing in T-bills and doing some option trades to provide income on a monthly basis. So let's take a look and see if this fits into our portfolio. If that is what you're looking for, please stick around. Whoop. From the mountains of Colorado. Yes, this is your ultimate cannabis ETF. No, actually, it's not. It's just a clever ticker symbol that Simplify used that will be easy to remember when you talk about how I got high in my portfolio, or whatever it is that you want to use as your go-to when you talk about HIGH. Now, I do think this is a clever ETF, and I like the idea because if you've been watching my channel, you know this is kind of right in my wheelhouse. I've been a proponent of keeping extra cash on the sidelines because I'm a little bit iffy about the economy. Having said that, I've been wrong, right? And for that reason, just so you know, I buy every single week. I buy stocks every single week, whether it's through auto investing or my 401k, and I continue to build those positions. But I am keeping a large pile of money on the sidelines, and I generate additional income aside from that being in a money market by selling puts and calls, put and call credit spreads. That works out pretty well for me. So I can keep up with inflation in a sense by doing that. It's been very successful for me. And then along comes this ETF that essentially does the same thing. So if you're willing to pay 51 basis points to Simplify for HIGH, they're going to take your money, they're going to put it in T-bills, very conservative T-bills, and then they're going to add an option overlay to generate some additional income. Same thing that I'm doing, and they're doing it with conservative options. That doesn't mean that there's not more risk, but if you're comfortable with this idea, I could see a person taking some of their cash on the sideline that they've been worried about and fighting inflation by using something like HIGH. So that's what we're looking at. So let's cruise on over to the Simplified ETFs website and take a look at HIGH, which they have dubbed the Simplify Enhanced Income ETF. Now, if you like any of their offerings, I suggest you come over here and take a look at their website because they've laid out all this information really nicely for retail investors like you and I. But the current price is $25.10. It hasn't deviated too much from that $25 price tag. We'll take a look at that. But it seeks to provide monthly income, so we're going to get a check every single month. And they're doing this by selling short-dated put or call spreads on things like SPX, the S&P 500 index itself, and fixed income indices like TLT. So we'll take a look at that. And the base of this whole idea is if you give them your cash, they're going to go and put it into T-bills first, and then they're going to add this option layer on top of it. Now they've got another little comment down here where they say a sophisticated option writing algorithm seeks to sell spreads that generate attractive risk-adjusted returns. They're also adding an additional layer of risk management that helps manage tail risk associated with selling options. So as someone that likes to sell lots of options, the worst case is what you want to avoid, right? That's what tail risk means. Basically, that's the natural disaster that we want to avoid. So they're going to set this up to hopefully be able to manage any kind of tail risk events. And they're already doing that a little bit by selling put and call spreads. So we are going to limit our losses already by defining our risk. And then we have additional things that we can do in case a tail risk event occurs. Now, as we scroll down here, we're going to run into a nice video here from Larry Kim. He's the managing director. This is a deep dive into HIGH, and I would suggest that before you go click the buy button, that you watch this video and reinforce what I'm telling you here right now. Make sure it makes sense for what you're trying to accomplish in your portfolio. Now, the fund overview, a couple good facts here. Total assets, $71 million, so not huge, but growing. And part of that is the inception date was just 10/27 of 22. Now, the expense ratio is what I really want to focus on. That's 51 basis points. I would say that's $51 for every $10,000 I invest. So that's pretty reasonable when you think about how they're managing these option trades for us. So you are getting something for paying that $51 per $10,000. So I would think of this as, am I able to get a nicer distribution without losing the basis of what I'm putting into this fund in excess of what I'm getting from my normal T-bills? So if I'm getting 5% from T-bills, well, I know if I put into this fund, I need at least 5.5%, right? But if I'm getting 6 or 7 or 8%, then I'm a little bit ahead of a curve if I'm putting some of my cash into this versus leaving that cash on the sidelines. And we'll also see that their distribution yield is currently 9.63%. So their goal here is the T-bill rate, which is currently 5.5% for a 6-month T-bill, and then about 3 to 5% from that option income. So 5.5 plus, let's say 4, gets us to about 9.5%. That's kind of where we see it currently. So if we scroll down here and we try to understand better what they're actually trying to do, let's go all the way down to recent distributions to understand this first too. Real quickly, ordinary income, 20 cents every single month. That's what they're distributing. No return on capital, total 20 cents. So been very consistent so far, and that is their goal, is not to give us any return of capital back in this particular case. So now let's take a look at what's most important, their portfolio holdings, and try to understand exactly how this is working for this fund. And boy, oh boy, is it exciting. If we give our money to this fund, they're going to go out and they're going to buy very exciting short duration T-bills to generate that 5.5% with expirations out here in October and December, it looks like. So that's the bulk of the money. And again, that's going to give us a nice base return, right around that 5 to 5.5% currently. Then on top of that, we're going to try to add some income through option strategies. Now, all I have open currently is looks like a spread, a call spread and a put spread against TLT, which is a 20-year treasury bond ETF from iShares. Very popular. Lots of options are traded against TLT. And actually, I love to wheel options on TLT myself, so maybe I'll show you some positions there. But TLT is currently sitting at 93 bucks a share. So that's smack middle in the middle of this. And the volatility of TLT isn't that great, so it doesn't move up and down that much. So these are pretty conservative options. And for somebody that's, I guess, used a lot of options, you might go, oh, I see that. That's an iron Condor. It's kind of like that setup. We don't have the exact same quantities out here. So I would just look at it as a call spread and a put spread. On the call side, with it being at 93, we've got a 98 and a 101. So these are the call spreads, right, that we are writing. And if I say writing, I'm selling, that's all the same thing. Or if I say I'm short, same thing, short, negative. 6,792 contracts at a $98 strike price. So we want it to stay below 98 to get our max credit at expiry. And if it goes out to 101, well, then we're going to have our max loss at expiry. But likely they might close this out early, right? That all depends on how they want to manage this, because it's completely managed by Simplify ETFs. Now on the other side, same thing. We have a put spread here, okay? So we want it to stay above 90, okay, because those are our short puts. And then our long puts that we're buying are out there at 86. So it's kind of our wings of our iron Condor. 86 is the worst case. 90 is the best case. We want it to stay above that. So if it stays between 90, okay, on this side, and 98 on this side, again, it's right at 93. With expiration coming up on 9/22, we're gonna keep all that money, okay, and that's what they're gonna distribute every single month. And that's the idea. They're going to be selling very conservatively, right? They want to hit lots and lots of singles and then prevent disaster. Again, that's that tail risk event. And although they don't have any S&P 500 index options open currently, they will also add those at times. So they have a systematic approach that they're going to put those on, take them off, and that might also result in them just sitting in T-bills all by themselves. They're not going to just sell to sell. They're going to be looking for opportunities that work for their criteria to put those option trades on to generate income for this fund. Now let's jump over to Seeking Alpha and look at the 1-year chart for HEQT. And you're going to see, as I mentioned, and it really hasn't deviated too much from that $25 price tag as they distribute that monthly income. But what I want to show you here at Seeking Alpha is the analysis on this particular fund. So in this case, we got a fund that generates income from selling option spreads. And if we jump into this article, it's going to get into lots of great details that you can read through. And this is one of the reasons that I promote Seeking Alpha on this channel. I'm an affiliate. There are affiliate links down below. Offering right now, I think, 50 bucks off. So no sales pressure, but I want to illustrate what it can do for you with new funds like this. So if we jump over here down to the comments section, we're going to see, for example, Darren here talking about a very interesting week as they're doing some SPX options and some TLT options. So utilizing this information, I can get more comfortable with the idea of adding something like HIGH to my portfolio, because I can see now how they're managing some of these because of the good work from Darren and the rest of the people in the comments section down here. So one more perk and one more way that we can get more comfortable with adding something like HIGH to our portfolio. So what's the use case for something like HIGH in my own personal portfolio? For me, my risk profile would allow me to take some of the cash from my cash position and move it into something like HIGH. And I believe I can fight inflation this way, right? Over here, I'm going to pay 51 basis points, but I believe that Simplify will return more than that in option income. So that would be my use case and what I might actually do with some of my money. Now, I do own a few shares of HIGH in a retirement account. It was in cash. Now it's in HIGH. We'll see how it performs. But if you have any questions on this at all, please ask down below. I really appreciate you watching. And like and subscribe if you like this type of content. We'll see you next time. Take care.